Okay, Nana. The principle of maximum social advantage. This principle is a fundamental principle of public finance. The principle of maximum social advantage was introduced by British economist Hugh Dalton. We know that according to Dalton, public finance is concerned with income and expenditure of public authorities and with the adjustment of one with the other. Here, the principle of maximum social advantage states that public finance leads to economic welfare when public expenditure and taxation are carried out up to that point where the benefits derived from the public expenditure is equal to the sacrifice imposed by taxation. So the benefits derived from the public expenditure is known as the benefit per rupee of public expenditure is known as additional utility or marginal utility. Marginal utility of expenditure and sacrifice when people pay tax to the government, they are sacrificing something. It is disutility to the taxpayers. So, by incurring expenditure, the government is offering some goods and services to the people. Through these services, they are getting benefits. So, benefits of expenditure by the government and marginal disutility or sacrifice imposed by the taxation. If both are equal, there the social advantage will be maximum in the economy. So friends, according to the best system of public finance is that which secures maximum social advantage from the operations which it conducts. Under the public finance, the government initiate some measures or operate some functions. They are public expenditure. By incurring expenditure by the government providing various facilities or services to the people. Through this, they are getting some taxpayers or people are getting some benefits. This is known as a marginal utility or marginal benefit. It is also known as marginal social benefit. If the government levy taxes on people, these taxpayers, while paying a tax, they are sacrificing. It is disutility to the taxpayer. So, per rupee taxation, they are sacrificing an additional utility. It is known as additional disutility, marginal disutility, marginal sacrifice. It is also known as marginal social sacrifice. Okay, friends. Here, so the principle of maximum social advantage, it is stating that public finance leads to economic welfare when the public expenditure and taxation are carried up to the point where the benefits, marginal social benefit is equal to the marginal social sacrifice. Where these two curves intersect each other, there marginal social benefit and marginal social sacrifice both are equal. At this point, the economic welfare or social advantage in the country will be maximum. So, with these two concepts, Dalton explained this principle. Marginal social sacrifice, MSS, marginal social benefits, MSB. This principle based on some assumptions. All taxes result in sacrifice. All public expenditures lead to benefits. So taxes lead to sacrifice or disutility to the people, and public expenditure leads to benefits to the people. So public revenue consists of only taxes and no other sources of income to the government. Here we are considering that the public revenue consists only taxes, not non-tax revenue. So based on these assumptions, the government has no surplus or deficit budget, but only balanced budget. Here we are assuming that based on these assumptions, we are discussing the principle. So there is no surplus budget and deficit budget, but there is only balanced budget. And the public expenditure is subject to diminishing marginal social benefit. Taxes are subject to increasing marginal social sacrifice. So if the public expenditure increases, marginal social benefit decreases. There is an inverse relationship between these two. So the marginal social benefit curve has negative slope. And taxes are subject to increasing marginal social sacrifice. If taxes are increasing, marginal social sacrifice also increases. There is a proportional relation or positive relation. So the marginal social sacrifice curve has negative slope. So both these curves, marginal social benefit curve and marginal social sacrifice curve, when these two curves are intersect each other, there it is known as equilibrium point. At this equilibrium point, the economy will be at maximum social advantage state. Okay, friends. Like this, marginal social sacrifice has positive slope. It upwards from left to right. And marginal social benefit curve, it has a negative slope, which downwards from left to right. If public expenditure increases, marginal social benefit decreases. So there is an inverse relationship or negative relationship between these two factors. So this curve indicates that there is negative relationship between public expenditure and marginal social benefit. So when these two curves are intersect each other, like in the diagram, MSS and MSB, marginal social sacrifice curve, intersects with the marginal social benefit curve. At this P point, the social advantage, social utility or marginal utility is maximum in the society. Like this, the principle of maximum social advantage states that social advantage is maximized at the point where the marginal social sacrifice cuts the marginal social benefits curve, where the marginal utility of public expenditure is equal to the marginal disutility of tax paying. So here, at this P point, the marginal disutility or to social sacrifice is equal to the marginal utility or social benefit. So, like this, friends, the maximum social advantage will be attained in this way, in this manner, which is discussed by Hugh Dalton in his principle. So, the maximum social advantage attained only at P point where marginal social benefit and marginal social sacrifice, both are equal to each other. So this point is known as maximum social advantage point. So where the MSB is equal to the MSS, the society will, the people in the society or the taxpayers in the society will be maximum benefited. So this maximum social advantage point shows that to obtain maximum social advantage, the public expenditure should be carried up to the point where the marginal social benefit of the last rupee spent becomes equal to the marginal social sacrifice of the last rupee paid as taxes. So the next one is, in our syllabus, we have one more thing, taxation. Here, taxation. What is tax? Tax is a compulsory payment or charges imposed by the government and to be paid by the taxpayers. It is known as tax. Okay, friends. So, by imposing tax, by collecting the revenue from the taxes, the government incur public expenditure for the provision of various services and facilities to the people in order to promote the social welfare. So the tax is a must. It is a compulsory charge by the government. So tax is a part of public revenue. Under tax revenue sources, there are two sources are there. Tax revenue sources, non-tax revenue sources. Under tax revenue sources, there are two types of taxes are levied by the government: direct taxes and indirect taxes. Okay, friends. For example, direct taxes. Direct taxes, for example, income tax, personal income tax, which is levied by the government on the income earned by a person. So it is a part of public revenue. So here, a tax is a compulsory charge or payment imposed by the government on individuals or corporations. If the tax is imposed on the income earned by a person or individual, it is known as income tax. It is also known as direct tax. If the tax is imposed on the sales of goods and services, it is a tax on corporations. It is known as indirect tax. Sales tax, GST, these are all indirect taxes. So friends, the most important source of income of the government is taxes. So the act of levying taxes is called taxation. The government to revenue by levying taxes on people or corporations. These revenue collected by the government through the taxes will be incurred as public expenditure for the implementation of various programs and for the provision of services and facilities in the country. So, the persons who are taxed have to pay the taxes irrespective of any corresponding return from the goods or services by the government. Here, friends, the tax is a compulsory charge. We are saying that a tax is a compulsory charge or payment imposed by the government. So the persons or the individuals or corporations who are paying taxes have to pay the taxes irrespective of any corresponding return from the goods and services by the government. So the taxes may be imposed on the income and wealth of persons or corporations, and the rate of taxes may vary. For example, the rate of taxes or the slabs of taxes may vary, person to person or corporation to corporation. But it is a compulsory charge. It is a compulsory payment. So to raise the objectives of taxes are, we can discuss in the following manner: to raise the fund revenue for the government, to implement various programs for the development of for economic and social development, and to regulate the consumption and production. The tax is imposed to regulate the consumption and production also in some times. So by paying the tax, the disposable income of the consumer will be decreased. It has effect on the consumption expenditure of the individual. Like in the same manner on the production also. And the objectives of taxation, one of the objectives is to encouraging domestic industries. So the tax is imposed on various business operations and production operations of the industries to encourage their production, their market. And one more objective is to stimulate investment in the economy and to reduce income inequalities. So the income tax, if it is progressive, if the income increases, tax rate also increases. So here to reduce the income inequalities in the economy, the government imposed these taxes. And to promote economic growth and to develop backward regions and to ensure price stability in the economy. For these purposes, taxes are imposed by the government. These are the objectives of taxes. Next, canons of taxation. Canons of taxation. Canons means some rules to be observed in formulating tax structure. So that before canons of taxation, we can discuss the types of taxes also. Taxes are divided in various types. For example, proportional taxation, progressive taxation, regressive taxation, digressive taxation. For example, proportional taxation. Under this type of taxation, the tax rate is constant as the tax base increases. So, the proportional tax is a constant tax. As tax base increases, it is not increased. It is known as proportional tax. And progressive taxation, if the tax rate increases as a tax base increase, it is called as the progressive taxation. Progressive taxation. So friends, if the tax rate increases as a tax base increase, it is called as progressive taxation. And the regressive taxation, when the tax rate declines as the tax base increases, it is called regressive taxation. If tax base increases, tax rates decreases. There is an inverse relationship between these two. It is known as regressive tax. Regressive tax. And one more thing is there, one more type of tax is there, digressive taxation. This tax structure is applicable to a few selected taxes. Under this tax system, the tax rate is progressive until a particular level of tax base or later becomes constant. So these are the types of taxation. Next, we discuss the canons of taxation. Here, the canons are the rules to be observed in formulating tax structure. So, the canons of taxation, the concept of canons of taxation is originally laid down by the father of economics, Adam Smith. In his book, he gave only 4 canons of taxation. They are canon of equity, canon of convenience, canon of certainty, canon of economy. And some other canons are also there. Before we discuss other canons, first we discuss the canons proposed by the Adam Smith. So Adam Smith's canons of taxation, we discuss 4 canons of taxation in this. First one is canon of equity. Canon of equity. It is also canon of equality. In the words of Adam Smith, the subjects of every state are to contribute towards the support of the government as really as possible in proportion to their respective abilities, in proportion to the revenue which they respectively enjoy under the protection of the state. So, according to Adam Smith, the government collects taxes from the people. The amount is spent on various items of expenditure which provide certain public services to the people. As per the canon of equality or equity, the burden of taxation should be in accordance with the benefits received by the people from the state. You remember this? As per the canon of equality or equity, the burden of taxation should be in accordance with the benefits received by the people from the state. It is understood that people who enjoy the benefits pay the taxes. So it is known as canon of equity. There is another canon, canon of certainty. It is also developed by Adam Smith. This canon of certainty describes that the tax which each individual has to pay ought to be certain and not arbitrary. the time of payment, the amount to be paid ought to be clear and plain to the contributor or to every other person. So the taxpayer should know the certainty of the taxes. What is the time to pay the tax? What is the amount to be paid as tax? This certainty should be there. It is known as canon of certainty. Canon of certainty. Next, the canon of convenience. According to Adam Smith, third canon of taxation is canon of convenience. This canon of convenience states that every tax ought to be so levied at the time or in the manner in which it is most likely to be convenient for the contributor to pay it. So it implies that the time, the method of tax payment should be convenient to the taxpayers so that the taxpayers are able to pay their taxes within the stipulated period of time. So this canon suggests that the tax system should be such that it encourages taxpayers to pay tax in time. This is known as canon of convenience. A convenient tax system increases government revenue as the taxpayers do not feel any inconvenience in paying their taxes. So, over a period of time, tax reforms have taken place in the tax systems and the canon of convenience has been given importance by the government. For instance, in India, the salaried class pays income taxes at the time of receiving salaries. As in case of consumers, paying sales tax is a convenient at the time of purchase of goods and services. Hence, it is included in the price. For example, when the consumer is purchasing some goods and services, including in the price, they are paying the value-added tax also. GST, they are paying GST 2%, 4%, 8%, 12%, like this. As part of price, they are paying at the time of purchase of goods and services. This is the convenience of taxpayers. It is known as canon of convenience. Another fourth canon of Adam Smith is canon of economy. Here, the Adam Smith enunciates every tax ought to be contrived as both to take out or keep out of the pockets of the people as little as possible over and above what is brings into public treasury of the state. This means the amount of tax should be minimal. Its cost of collection should be lower than the revenue raised from it. For example, if the government is laying a tax on the people, by laying or by collecting taxes from the people, the government is earning 100 rupees. For example, 100 rupees. For the collection of these tax from the people, the cost of collection of tax is more than 100 rupees. It is not viable. It is not economical. So the canon of economy states that the amount of tax should be minimal and its cost of collection should be lower than the revenue raised from the tax. So the difference between the revenue generated in the form of tax and what government receives after meeting all expenses for the collection of taxes should be meager. So this canon tells that the taxes should not have adverse effect on production because high tax reduces savings and capital formation. High taxes on harmful commodities like drugs, cigarettes are regarded as meaningful because this tax results in the reduction of consumption of undesirable commodities besides increasing public revenue. But the tax should be minimal and the cost of collection of tax should be lower than the revenue earned by the government from the tax collection. These are the 4 canons of taxation which were developed by Adam Smith. Okay, friends, canon of equality. This states that persons should be taxed according to their ability to pay tax. If the tax is beyond the ability of the taxpayers, they always tries to evade the tax. So the equality canon should be followed in formulating taxation or tax structures by the government. And canon of certainty, it states that the manner of payment, the time of payment of tax, the amount to be paid should be clear, to be certain. It should not be arbitrary to the taxpayer. Certainty should be there. And canon of convenience states that it should be convenient to the taxpayer. So the government should impose and collects the tax at the time when the taxpayers receive their income or salaries. And canon of economy states that the cost of collection of taxation should be minimum. And other economists also suggested some more canons of taxation. Other canons of taxation. Canons of productivity. This canon of productivity was formulated by classical economist Bastable. According to Bastable, this canon of productivity is also known as canon of fiscal adequacy. According to this canon of productivity, taxes must be levied in order to accumulate a satisfactory amount for the government to run its administration effectively or efficiently. So the government should raise adequate revenue to meet its expenditures to provide enough facilities for the people in the country. So, if the revenue generated in the form of taxes is not enough to run the administration efficiently, it is not called as a productive tax. The productive tax should be levied in order to accumulate a satisfactory amount for the government to run its administration efficiently. It is known as canon of productivity. Instead of taxing a multitude of items yielding small revenue involving high cost of collection, it would be advisable to depend on few items of taxation which yield large revenue with a low cost of collection. This is the reason why this is the reason for abolishing the estate duty and gift tax in India in 1985 and 1998 respectively, as they generate less revenue. So friends, in India, the government abolished estate duty and gift tax, as these taxes generate, they were generating less revenue to the government, but the cost of collection of these taxes were more than the revenue generated. So the canon of productivity may assume that taxation should be encourage the productive effort of the people. It should not discourage the production. It means that a tax should act as an incentive to produce more. Thus, another canon is canon of elasticity. The canon of elasticity states that taxation should be elastic in nature, so that the amount to be collected in the form of taxes can be decreased or increased depending on the requirements of the government. So the government may increase or decrease depending on the various circumstances demanded. So in the interest of the development of country, when the country faces adverse conditions like natural calamities, wars, earthquakes, the governments may need to generate more revenue. In this adverse condition, the government may increase the tax rates. The government increases the taxes. Hence, tax should be adaptable to the changes in the financial requirements of the government. So the government expenditure increases every year. Generally, we are expecting, and it is regularly the government expenditure increasing in the modern states. Hence, tax should be elastic enough to increase the revenue in case of need, and also revisable as and when the circumstances needed or demanded. So friends, here the GST or service taxes, they are more elastic because of its coverage and rate, and revenue has been drastically growing right from its inception. And another canon is canon of simplicity. Canon of simplicity. Here the tax system and tax forms should be simple. According to this canon, tax forms or tax system should be simple. Taxes should be precisely laid down and can be easily identified by the taxpayers. So there should be absolute clarity without any ambiguity about tax laws, and a common man should be able to understand them easily without any difficulty. Tax exemption should be defined clearly. If the tax system is too complicated or cannot be easily understood, the taxpayers will have to seek the assistance of tax officials or tax consultants. If it is a complex, it leads to the evasion of taxes, creates legal disputes, encourages tax authorities for manipulation, thereby leads to corrupt practices. So the people do not hesitate to pay taxes when the tax system is fair and simple, when its implications are understandable without the help of tax experts or consultants. A complex system of taxation is always unjust and uneconomic. Unfortunately, in India, some taxes like income tax and value-added tax is complex, and they cannot be easily understood by the of tax paying by more. We can experience this. So there should be a simplicity in levying tax and paying tax. Another canon is canon of diversity. This canon of diversity, it means that all those citizens who can contribute to the government revenue should be brought into the tax purview. For instance, taxes should be spread over industries, businesses, services, professions, transport systems. In other words, the diversification of taxes should be practiced in such a way that every section of community or society and every individual must contribute something to the government exchequer. If the government follows a single tax system, it is easy for the people to evade tax or escape from the purview of the tax system. But if the government imposes multiple taxes, it will be difficult for the people to evade tax or escape from the tax net. So there should be diversity in formulating the tax structure. Another canon is canon of flexibility. This canon states that tax should be flexible but not rigid. Technically, there is a difference between two of them. The canon of flexibility seems to be similar to the canon of elasticity, but there is a difference between these two. A canon of elasticity states that there should be possibility to increase or decrease the revenue, whereas the canon of flexibility states that the tax system should be flexible but not rigid. So friends, according to this canon, the tax system should be flexible. If a tax is flexible, it can easily adjust to the new conditions. It is possible to revise a tax structure so as to fit into the changing requirements of the economy. Another canon is canon of expedience. According to this canon, tax should be based on some well-defined principles so that the taxpayers accept its desirability. So a tax should have social, economical, and political advisability so that the taxpayers need no justification from the government. Sometimes a tax seems to be desirable and satisfies many canons, but government will not impose it. It is because of this reason, progressive agricultural income tax in India is desirable but not expedient. So the taxpayer the taxpayers have to accept its desirability. And another canon is canon of coordination. This canon states that there should be coordination between different taxes that are levied by various tax authorities. For example, in federal system of government like India, the taxes are levied by central, state, and local governments. In all these cases, it is needed that there should be a definite coordination between various taxes levied by different governments. There was a problem in imposing and collecting value-added tax in various states. So the Indian government introduced a single tax for all India, that is GST. So there should be a coordination between the different taxes that are levied by the various tax authorities, central government, state governments, and local governments. And the excise duties in India have been levied by the central government. The sales tax levied by the state governments. The octroi tax by local governments. These are the taxes levied by various tax authorities in India. In such a kind of nature of the tax system, there should be coordination among them. Another canon is canon of development. According to this canon, taxation intends to bring socio-economic development in the country as a whole. So it does not hamper the development of trade and industry. It reduces the economic inequalities. It does not slow down the rate of investment in the country. The tax revenue should be utilized for the promotion of welfare of the people. So the taxes should be based on the socio-economic policies of the government. So this canon states that the revenue generated in the form of tax should be vested in productive development activities, but should not be wasted for undesirable activities. So these are the canons of taxation we discussed. And classification taxes, we already discussed this. Direct tax and indirect tax types are there. The initial and final burden of tax, which is borne by the taxpayer, is known as direct tax. And in the case of indirect tax, the initial tax burden is on one person, and the ultimate tax burden will be on another person. It is known as indirect tax. And proportional tax, progressive, regressive, digressive taxation, we already discussed this one. And incidence on taxation. Here, friends, impact of tax means initial money burden of a tax. Clearly understand that concept. Impact of tax means initial money burden of a tax. But incidence of tax means ultimate or final money burden of a tax. So, the final resting place of a tax is known as incidence of taxation. According to Seligman, the settlement of tax burden on the ultimate taxpayer is known as the incidence of taxation. It can be also said that the person or persons who ultimately bear the burden of taxation, they are bearing the incidence of taxation. It is known as incidence of tax. Impact of tax means it is an initial money burden of tax is known as impact of tax. But the final or ultimate tax burden is known as incidence of tax. Dalton, Dalton's defined tax incidence as to every shilling of revenue raised, there corresponds a shilling of direct money burden or incidence falling upon someone. As per Wood Dalton, it is to be found out that who ultimately pays this 1 shilling. So the final or ultimate money burden of a tax is known as incidence of tax. According to Dalton, the imposition of a tax causes 2 types of burden on the people. One is money burden, another one is real burden. Money burden means the amount of tax which has to be paid by the taxpayer to the government. The money burden can be either direct or indirect. So the direct money burden refers to the actual amount of tax collected in terms of money. Indirect money burden of a tax may arise when a taxpayer may be forced to part with a larger amount than the rate of tax warrants. So the money burden means the amount of tax which has to be paid by the taxpayer to the government is known as money burden. But the real burden, it relates to the sacrifice which the imposition of a tax entails on the taxpayers. So it can also be divided into two types, namely direct and indirect tax also. Tax real burden, direct real burden, indirect real burden. But the real burden of a tax is the sacrifice which the imposition of a tax entails on the taxpayers. So by paying the tax, the taxpayers are sacrificing something. This sacrifice is known as a real burden, according to Dalton. And Hicks also classified the incidents of taxation into two types: formal incidents, effective incidents. According to Hicks, formal incidents refers to the direct money burden of a tax. It is also Dalton's direct money burden of a tax. Here, the formal incidence is the proportion of people's income which is collected by the persons who provide them with goods and services, but paid over to the governing bodies to finance collective satisfaction. So, the formal incidence refers to the direct taxpayers. Another one is effective incidence. According to Hicks observed that the calculation of formal incidence does not tell us directly of the taxpayer's reaction to the changes of taxation and various consequences of the tax. In this way, Hicks defines the second concept of effective incidence as follows. In order to discover the full economic consequences of a tax, we have to draw and compare two pictures, one of the economic setup as it is with the tax in question, the other of a similar economic setup but without the tax. So here it points out that the effective incidence refers to all these different economic consequences which result from the imposition of each tax and which changes the pattern of production, demand for the goods and services, allocation of resources, volume and direction of savings and capital formation. This is known as effective incidence. According to Richard Musgrave, there are various types of tax incidences: specific tax incidents, differential tax incidents, specific expenditure incidents, differential expenditure incidents, balanced budget incidents. So specific incidents, if the government makes a change in a tax, the resulting change would be in the distribution of income available for the public use. Making no changes in the public expenditure is called specific incidents. The differential tax incidence means when a tax is substituted by another tax and there is no change in the total revenue received by the government, then its effect on the distribution of income available for private use will be termed as differential tax incidence. So friends, these are the incidences of taxation developed by various economists. Another one topic is effects of taxation. Here, according to classical, the purpose of taxation is to raise the required revenue for the state. However, in the course of time, this objective have also been changed. Therefore, in modern times, the purpose of tax is not only for raising revenue to the government, but also an important instrument for achieving socio-economic objectives like reduction of income inequalities, reduction of or elevation of poverty, promotion of economic growth, and stabilization of prices in the economy. So friends, when the tax is imposed, it will affect the taxpayer in terms of reduction in the disposable income and the working of the economy in terms of production, growth, consumption, saving, investment, income, and wealth. So all these results and changes are collectively called as the effects of taxation. So when the government imposes tax, this tax affects the taxpayer in terms of the reduction in their disposable income and also the working of the economy in terms of changes in production, changes in consumption, changes in growth and savings, investments, and income and wealth. These are all called as effects of taxation. According to Hu Dalton, the best system of taxation from the economic point of view is that which has the best or the least bad economic effects. So, which tax has the best or the least bad economic effects, it is the best system of taxation, according to Dalton. So here the Dalton discussed the effects of taxation in 3 heads. One is effects of taxation on production, effects of taxation on distribution of income and wealth, and other effects in the economy. For example, effects of taxation on production, first one. Hu Dalton discusses the effects of taxation on production under 3 more heads. One is effects of taxation on people's ability to pay or ability to work, ability to save, ability to invest. So there is an effect of taxation on people's ability to work, ability to save, ability to investment. And another effect is effects of taxation on people's willingness to work, willingness to save, and willingness to invest. And another effects of taxation is on allocation of resources between different industries and regions. For example, friends, effects of taxation on production, there are 3 heads are there. Effects of taxation on people's ability to work, ability to save, ability to invest. People's ability to work depends on their standard of living. Higher the standard of living, higher is the ability to work. When a tax is imposed on the consumer, it immediately reduces the purchasing power of the consumer due to a part of his income is being paid as taxes to the government. Here it is affecting the ability to work, ability to save, ability to consume, ability to invest. Like in this manner, it also affects the people's willingness to work, save, and invest also. So it is easy to find the adverse effects of taxation on the ability to work, ability to save and invest, whereas the effects of taxation on willingness to work, save, invest are not easy. To analyze these effects of taxation on willingness to work, save, invest, we should be able to differentiate the effects of taxation on individuals and farms. If the individuals pay tax out of their income, if a taxpayer wants to maintain the pre-tax income as it is, he works hard, earns more so that he tax paid out of the increased income and the pre-tax level of income is maintained. This is affecting by imposing or by paying the tax. And the effects of taxation on allocation of resources between different industries and regions. Here the government can use its tax policy to divert the scarce resources of the country in the desired productive activities. Thus, taxation may influence not only the volume of production and national income, but also the pattern and composition of production in the country. If the government wants to discourage the production of tobacco products, the government levy high taxes on the production of these products. So here the taxation is affecting the allocation of resources between industries and regions also. And another one is effects of taxation on distribution. So in the modern times, the purpose of taxation is not only to raise revenue for the government, but also to reduce the inequalities of income and wealth in the country. So taxes are powerful tools to achieve more equitable distribution of income and wealth in the economy. Through the taxation, the government can achieve this objective. So the effects of taxation on distribution of income and wealth among the different sections of the country depend on two things. For example, nature of taxation and tax rates. Another one is kinds of taxes. For example, nature of taxation or tax rates. If we examine the effects of taxation on the distribution, we should understand the tax system in a country, whether it is progressive, regressive, or proportional. A progressive tax system reduces the inequalities of income and wealth in the society because a huge direct real tax burden falls on the high income groups or the rich people. If the tax system is more progressive, it can easily reduce the economic inequalities in the country. On the contrary, if a tax system is a regressive, it causes more inequalities in the distribution of income because the poor will have to bear a relatively higher tax burden. And we can also discuss the effects of taxation on distribution depending upon the kinds of taxes. Whether the taxation is progressive, regressive, or proportional depends upon the kinds of taxes. Kinds of taxes means direct taxes or indirect taxes or both. Direct taxes are more progressive. These are more suitable to reduce inequalities in the income. Income tax, wealth tax, corporation tax are progressive in nature. They bring revenue from higher income groups. So they help more in bringing about the reduction in existing inequalities of income and wealth in the society. Next, other effects of taxation. Other effects of taxation. Taxes can influence the level of employment in the economy, the business operations in the economy, the savings and investment pattern in the economy, the consumption of employment in the economy, people's consumption by reducing their purchasing power. The decline in consumption causes reduction of demand for goods and taxation affects employment is different in case of developed and developing countries. So taxes can influence the level of employment. Taxes can influence the economic activity of the business operations of the business activities of the business firm. So these are the other effects of taxation. Okay, friends, today in this class, we discussed about the a principle of maximum social advantage, which was developed by the Wu Dalton, and the taxation and various types of taxes, classification of taxation, and impact, incidents and effects of taxation, and canons of taxation today. Okay, friends, by this, we are ending here this class. Okay, Nana, I am in class for today. I am requesting the organizers to end this class for today. Thank you very much, friends.